Yeah, good evening, participants. I am Vijay Kanchan, and I'll be conducting this webinar on the impact of the global impact on Indian markets. Uh, so, to begin with, we all know that the global factors they can significantly sway or move the Indian financial markets, sometimes subtly and sometimes very significantly. So what I'll do is I'll just give an overview of what exactly happens, and then we will look into some specific instances where the Indian markets, corrected sharply due to some major global events happening. So the first is to begin with the trade and investment flows. Uh, if there are slowdowns happening in the major economies, for example, the US, the China, the Eurozone, etc., this reduces the demand for Indian exports. It's not considered positive for the Indian markets. Sometimes there could be supply chain disruptions, mainly because of geopolitical factors, pandemic, etc. This will raise the input cost for Indian firms. Uh, Capital flows also gets affected largely due to investor sentiment. So the foreign investors, particularly the FPIs, they react very strongly to global cues. For example, inflation numbers, or if there are rate hikes, or again geopolitical risk. So they can cause inflows and outflows in Indian equities. Uh, in the market, uh, we have basically two sentiments, so as to say a risk on sentiment and a risk of sentiment. A risk on sentiment means people are willing to take the risk and invest more in the markets. Risk of sentiment would generally happen if there is some large negative event, and risk of sentiment can trigger huge sell-offs in emerging markets like India. Uh, a strong dollar index, technically, I mean, what we call as a DXI, this can weaken the Indian rupee. It will be beneficial to certain sectors like IT, pharma, etc. But in general, it pushes up the import cost and widens the current account deficit for the country. So it's not considered very good. Similarly, commodity prices, India being a large exporter of oil, uh, can inflate the India's import bill. Similarly, global food prices, metal prices, etc., they can influence domestic inflation and margins. So our imported margin can shoot up significantly. So if you look in terms of zone, uh, how they impact India, for example, USA, the Fed rate decisions impacts our markets. Yesterday, to give an example, the Fed kept the rates unchanged. So in a way, that was positive for market. Uh, but then what has happened on the tariff front here is uh, uh, the Trump administration has imposed a 25% tariff yesterday, all of a sudden, and the markets have not reacted very positively to this event. So US made the Fed rate decisions, the earnings of their tech companies, recession fears, etc. They affect liquidity and sentiment. Uh, when you look at the Eurozone, the policies of ECB, their energy market dynamics, they also influence Indian inflation and exports. China being the manufacturing hub, so any manufacturing trend and demand cycles will affect the raw material prices in India. Middle East, we all know oil prices, volatility, and remittances will impact the flows and put pressure on our balances. Some historical examples: the global financial crisis, the COVID-19 pandemic, the Russia-Ukraine war. These are some of the events to which our markets have reacted very badly. Okay, so this is an overview of how the markets react to global events. So what I'm going to do is I will share the PPT. I will share the PPT, and this is how we are going to proceed. So this is going to be the flow of the presentation. I'll take some few examples, actually, what few case studies. Then we will have a look at the global market influences and how the trade linkages affect the whole system. So I begin with the JPY carry trade. But before I begin, I would like to ask, do you know or any one of you has any idea what is exactly the meaning of a carry trade or the JPY carry trade? Uh, would anyone know this? Have you heard this term before? Okay. Uh, a carry trade is a very special type of a trade in which traders buy or borrow currency where the interest rates are very low, and they would invest in a currency where the interest rates are very high. Some of them would go ahead and they would convert the JPY, borrow from a bank in Japan, convert the JPY into a convertible currency like a USD or a Euro or a British Pound, convert those currencies into wherever they are going. For example, they can convert USD into, let's say they want to enter India. So they will convert USD into the Indian rupee and then invest in assets in India. It could be the bond market in India or it could be the equity market. So what I will now show you is a, okay, so this is what a carry trade is all about. So you borrow in a currency with low interest rates and invest in a currency with high interest rates. The whole concept of carry trade originated in Japan in the early part of this century, and there are historical reasons for it. The Japanese economy, which was one of the best performing economies of the last century, would lose steam by the end of the 1980s. So for the 90s, basically it was a case of a lost decade for Japan. They had an asset bubble. Uh, their equity markets was richly valued. In fact, the PE for the Japanese market was close to about 40 times. There was a banking crisis. Uh, I mean, just to digress a little bit, if you look at the chart of any major markets in the world, of any major country, over a long period of time, the chart would just keep on going up. Because as the economy grows, the markets are also expected to do better. Japan is an exception. The high made by the Japanese market in 1989, okay, the high made by the Japanese market in 1989 was only broken sometime last year. So I hope you understand what I'm trying to tell you. An average Japanese investor having invested in the Japanese index would have made no money in the last 35 years. So that is what Japan is all about. So coming back to our theme, the carry trade. So the JPY, so what happened in Japan was, in order to revive their economy, in order to revive consumption, the Japanese government started following a loose monetary policies. They kept interest rates very low, practically close to zero. So when the currency of such a large economy, Japan during that time was the second largest economy in the world, and the currency was one of the major currencies in the world. So when such a large currency is available at practically, half a percent, quarter percent, this was the rate in Japan, it becomes attractive to certain class of traders. So what they will do is they will borrow JPY and invest in some other currency. So this is what is called as a carry trade. Carry trade became very popular in Japan. It was used by both the average Japanese housewife as well as some of the biggest institutions in the world. Uh, Interest rates was practically, kept close to zero in the early part of last decade. Uh, so what was happening in Japan was the favorite carry trade would be the JPY versus the Australian dollar and JPY versus the New Zealand dollar. The reason was the exchange rate between these two countries were fairly stable, and the JPY would marginally depreciate against these two currencies. So, and the interest rate in both AUD and the New Zealand dollar was much higher than what was there in the Japanese yen. So, for the initial 4 5 years, this was the favorite carry trade, uh, by the currency, done by the currency speculators. Now, what happened is sometime in 2006, 2007, the JPY started appreciating against these two currencies. So, whenever the JPY appreciates, it's not good news for the currency arbitrager. He will lose a lot of money because most of these trades are very highly leveraged. And that is what happened uh, so for the carry trade, particularly with respect to the Australian dollar and the New Zealand dollar. One more carry trade, which was almost picking ground, gaining ground, was the USD JPY carry trade. So what a typical trade will look like this. A trader will borrow in the Japanese yen from a bank in Japan, uh, convert it into US dollars, convert the USD into, let's say, an emerging market currency like India, INR, and invest either in Indian equities or Indian bonds. So this would be the structure of the trade. They may also invest the USD either in the USD bonds in US or Europe, or certain commodities like your copper, aluminum, etc., or in gold. So this so money originating from Japan through the carry trade route would be invested in risky assets almost all over the world. So now let me show you a diagram. This is how it looks like. Okay, you borrow from a Japanese bank, you borrow in terms of JPY. Okay, you are a carry trade speculator. You convert this into the some major currency like USD. You convert USD into the Indian rupee. You come to India and invest in Indian equities. Uh, Requesting all of you just have a look at these transactions, and can you please comment where all do you see risk originating when you have a structure like this? Can I get some of the comments, please? Okay, so I've got many responses. So let me try to explain this piece by piece. So the first is, what happens if interest rate rises in Japan? The borrower will now have to pay a higher cost, higher interest rate when he returns the currency back to the Japanese bank. So that is the first risk. The second risk is he's converted JPY against the USD, right? What happens if JPY appreciates against USD? He is going to again incur losses because he will now need more of USD to repay the same JPY. Next is, what happens if USD appreciates against INR? It's also a risk to him because he will now need more of INR if he converts it into USD. And finally, what happens if the Indian equity markets correct? Okay, so these are the risk which is emanating from this type of a structure. So what happened in May 2006 was something similar. The Japanese government, the Bank of Japan, had kept the interest rates unchanged in their March policy, but they had given indication that they are most likely to increase the interest rate in the next policy. So JPY gradually started appreciating against the US dollar. So this made the carry trade speculators very, very uncomfortable because they knew that if it continues like this, they are making huge losses. Most of these trades are leveraged, so a small loss can get magnified. So what happened in May 2006 and June 2006 was uh, all the major markets corrected. So trades which originated from Japan the carry trades. So will first sell. They will first sell and then do their calculation. And that is what those traders did. They sold across. So it was not only the equities, even the gold markets corrected, even the oil markets corrected, and even other commodities, the metals, etc., iron, your copper, etc., everything corrected. And this will surprise you. So I'll show you some statistics about the Indian markets. The Nifty, we were in the midst of one of the biggest bull market India had ever seen, the 2003-2008 bull market. So what happened was Nifty corrected from 3774 in May 2006 to about 2595, which means Nifty corrected by 31% in just about 6 weeks' time. What investors did, because they were making losses all over, they sold gold to cover their margin calls and rebalance their portfolio amidst rising JPY and falling equities. Crude prices corrected sharply because the view was the world may enter into a mild recession and the global demand for oil will come down. Base metals like copper, zinc, nickel, which practically reflects a strong economy when these prices keeps on moving up. So they also started correcting because there was a fear that some of these economies would go into a recession. Commodities, equities declined sharply, and many markets lost more than 30% during that period. Okay, so this is what uh, a global factor which actually had nothing to do with the India growth story. India was doing phenomenally well around that time, and because of a reason, the reason originated from Japan. Practically all the markets corrected in the world, including the Indian markets. Did you understand this? Participants, if you have any doubt, you can ask. Okay, so this is the JPY carry trade. Some of you may remember last year, again in the month of August, uh, the Bank of Japan had indicated that they are going to raise the interest rates, and JPY, which was trading around 165 with respect to the US dollar, had appreciated sharply to about 143, 144. This event spooked the markets, and last year in August 2024, Nifty, practically all the markets reacted very badly. Finally, the governor of Bank of Japan had to, he had to make a statement that the Bank of Japan will no longer, I mean, there will be no further rate hikes in Japan. So this sort of calmed down the markets, and the markets would eventually recover. So once in a while, your JPY carry trade can have a devastating effect on the markets. Okay, good so far. Any questions? Shall we go ahead? So a few questions. Let me try to answer it. So one question is exchange rate risk can occur if JPY appreciates against INR. Yes, yes, definitely. But then what happens? The JPY INR market is not such a big market compared to the USD INR market and USD JPY market. So that is the reason I gave an example using. So most trades around the world, the currency gets converted to USD and then get converted to the other currency. So someone asked me, is this type of a transaction going in our markets? Uh, the quantum of this transaction is not known because all this information is not easily available. So some of the FIIs who come to India, this was asked by GH. So some of the investors, FIIs who come to India have probably come through the carry trade route. So if JPY appreciates, then it is not good news. SS has asked where the problem actually happened in this crisis. The problem originated from Japan and it spread to the rest of the world. Okay, uh, fine. So let me go to the next one. Let me go to the next one. So let's analyze this. Why the sell-off happened? Because one was the liquidity shock. The Bank of Japan suddenly withdraw about 122 trillion, 12.2 trillion JPY in excess liquidity. Roughly, if you go look at those times exchange rate, that was it would tantamount to withdrawing about 200 billion USD, tightening by the Fed. The JPY appreciated by more than 5%. So if something like this happens, this makes the carry trade completely unprofitable. So what will happen is all such traders who have exposure to risky assets all over the world, the first thing they will do is they will just sell, and then they will do the calculations later on. So this causes a mayhem in the market. There is a bloodbath, and all risky assets uh, fall sharply. Okay, the risk of sentiment, as I explained to you earlier, risk on means your investors, traders are willing to take risk. Risk off means no one is willing to take risk. They would rather be cautious. So suddenly the sentiment became risk off. And what everyone did, including the hedge funds, including our own HNI investors, including mutual funds, basically they try to de-risk the positions by selling all these risky assets. This is what happened in 2006. Uh, so the lessons we learn here is your commodities are highly sensitive to global commodities cycles, right? So one event happening in one part of the world can affect asset classes all over the world. Your carry trade unwinding. Carry trade unwinding means the trader would sell off everything, reconvert it back to JPY and try to repay the bank. This is basically it's a non-fundamental shock. But then what happens here is the prices get disconnected from the supply demand dynamics. So the markets are no longer driven by fundamentals. They are driven by technical reasons in the market and terrible sentiments. We all say that the gold is a safe haven, but this statement needs to be qualified. It is context dependent. Whenever there is a liquidity crisis or whenever there is a stress in the market, gold prices will also correct because people may sell gold to take care of their margin calls and other losses. The next example which I am going to give is the subprime crisis. Most of you would have heard about the subprime crisis. Can I get some responses in the chat? What is your understanding of the subprime crisis? I think PG had asked a question, why and how the JPY appreciated? Is it because the Bank of Japan governor? PG, what happens is when you increase the interest rate in a currency, it attracts capital flows. So a major currency like JPY, if they keep on increasing their interest rates, Japan will attract capital flows from other currencies, and that will lead to JPY appreciating against other currencies. I hope I've answered your question. Okay. Uh, yeah, I got some responses. Your US real estate market crashed primarily due to bad loans. Lehman Brothers crisis. Same property has been used for loan. Okay, so the subprime crisis originated mainly due to the concept of securitization. So in US, what happened was uh, banks who are the originator of loans could actually pool this loan together and sell it to some other institution like an investment bank who then created securities out of this pool of loans. This process is called as securitization. These newly created securities were sold as AAA, triple B, double B, unrated, etc. Uh, the thing here was a triple A security created out of securitization is not the same as a normal bond which has a triple A rating. Unfortunately, many believe they were the same thing. So even some of the top institutions in the world had an exposure to such bonds, the triple A bonds, the double A bonds, etc. What was happening in US mainly after the September 2001 attack, US would go into a mild recession. So how did the Fed respond? The Fed kept on decreasing the interest rate after September 2001. So by December, the interest rates had fallen to 1.75%, so almost 50% below, and they would further reduce it. So that was one side of the story. The other side was the comments around that time. So two regimes, the Bill Clinton regime between 1992 and 2000, and the George Bush regime between 2000 and 2008, they encouraged, house ownership. So the policies were framed in such a way that it would encourage people to borrow from the banks and build their own homes. Now, because of this trust given by the market, uh, there were financial intermediaries who took advantage of the situation. Secondly, due to securitization, see, normally what happens when the bank gives a loan, it is taking a counterparty risk on the borrower. The bank's capital is blocked for the next 15, 20 years, and the bank is taking a individual risk on people who have borrowed from the bank. But thanks to securitization, what was happening at the bank's end? They would originate a loan, and within a week or within 10 days, the loan would be sold to some other third party, typically an investment bank. So the bank was not really concerned whether the borrower would be able to repay the loan. So the due diligence, the lending standards, everything got lowered. Uh, there were manipulations. The property prices were artificially, given a higher value. So the valuers were nothing but professional entities who are registered to value a property. They also sort of caught on to what was happening, and properties were given inflated, inflated prices. Uh, well, just like we have civil in India, in the US, there is something called as a FICO score. So some of the applicants were trained or coached to how to improve their FICO score. So to cut it short, loans were given to individuals who would definitely not be in a position to repay it. Not that the banks did not understand this or the institution did not understand this. The whole thing was based on the premise that property prices never correct. It keeps on going up. So the feeling was even if these people defaulted, the bank would seize the property. Uh, so the loans which were originally given, they were, originally had very low EMIs. They were called as teasers loan or all-day loans. So, and some of them only collected the principal, I mean, only the interest part, no principal was repaid. So now everyone thought ki we can borrow, the houses very cheaply, and everyone knew that property prices go up. So you borrow money from the bank, you buy a property, and after 2 to 3 years, you sell off the property and make a handsome profit. So practically everyone got into the game. What happened in US after 2005 was the interest rates bottomed out and the Fed gradually started increasing the interest rate. So the EMI portion of the loan would now become 2 times, 3 times, sometimes even 4 times. So a lot of people started defaulting, and a lot of people started selling their houses. This put pressure on the property prices in US. So all these mortgages, which was created out of the housing loan, Historically, there has never been a default of more than 5% across geographical areas. But what happened in 2007 and 2008 was the default would go to more than 30-40%, and in some cases, even more than 50%. So, securities created out of these housing loans would now become toxic. So, most of these banks, the large institutions, and some of the investment banks, for example, most of them had exposure to these securities. And one of the biggest player in this market was Lehman Brothers, the company which would eventually default in September 2015. They had a very large exposure to this type of assets, which we technically call as toxic assets. Now the call here was, would the US government bail out Lehman or not? There were many who felt that the government will finally intervene and bail out Lehman Brothers. But then what was happening in 2008 was this was an election year. And the George Bush administration was not really comfortable bailing out one more investment bank from Wall Street because earlier during the year, they had bailed out one more hedge fund which had become bankrupt. That was Bear Stearns. And the terms of the bailout was not favorable to the government. In fact, JP Morgan, uh, you know, got Bear Stearns at $2 per share, and all the toxic assets which Bear Stearns was holding, it it went into the books of the Fed. So many people did not like this because they started questioning the government. Why is taxpayer money being wasted to bail out the Wall Street firms? So the George Bush administration was not really comfortable intervening here. So on September 15, 2008, when Lehman Brothers finally applied for bankruptcy, it took the market completely by surprise, and there was a widespread selling everywhere in the world, including India. To give you a perspective, the Indian market, Nifty and Sensex, would fall by more than 50% in about a month's time. Okay, so here it is. So what happened to the FIs in the entire 2008? They pulled out over more than $13 billion. So look at the fall. January 2008, Nifty was 6,357, and by the third week of October, Nifty was 2253, a fall of more than 65%. This type of selling has never been seen in the Indian markets. The selling was unprecedented, and again, this had actually nothing to do with India. We did not have an exposure to these assets. Indian banks, RBI, for example, etc., did not have any type of exposure to the assets. But then what was happening is because these FIs were making losses in other markets, they had no other choice but to sell even in those markets where they were making profits. And India broadly sympathized with the rest of the world. The equity markets reacted very bad. Because of this outflow of dollars, the rupee depreciated because there was a capital outflow and a fear of rising risk. What was happening in the bond markets? Credit spread. Credit spread is the difference between the yield on the risky corporate bond and the yield on the government bond. In a normal market, these spreads are very low or very narrow. A narrow spread indicates a healthy economy. When the credit spreads widen, the economy would look to be in trouble. So the credit spreads widened, the corporate bond issuance slowed down, and global liquidity dried up. Uh, did you understand this? Someone has a question for the subprime. Uh, okay, PG, yeah. Uh, so your question is US banks were banking on the thought that even if the borrowers default, they can seize the property and sell it as property rate rises. If this is the case, why the banks or the securities felt? The reason here was so PG. I'll give you an example. The property price when the loan was taken was about maybe 1 lakh $50,000. and the borrower would have taken a loan of, let's say, 1 lakh 30, 1 lakh 35,000 dollars. What happened during 2008 was the property prices corrected by more than 50%. So, what do you think a borrower will do? He will obviously not repay the loan. He will surrender the keys and he will ask the banks to foreclose the loan. So the bank has to take a hit. PG, I hope you understood this. Why FIs pulled out their money in a staggered manner? Because as time passed, they would get lesser value. Uh, this was a question asked by SS. FIs were selling every day SS, almost every day. So they were huge sellers. India had never seen this type of selling ever before. Ever since FI started investing in 1992, this was the first time the Indian market saw a selling like this. To give you a perspective, if I remember correctly, the overall rupee number was close to about 1,10,000 dollars. If you go by the exchange rates prevailing then, so in those 10 months, they sold approximately 1,10,000 dollars of net selling, 1,10,000 dollars of equities. SB, how India fight back this condition? No, things eventually recovered, SB. After the selling was over, things would eventually recover. So what was happening in the Western world, especially US, was they came out with the quantitative easing, and in order to bring in liquidity, the US went on a bond buying program, and this would infuse liquidity into the system, and gradually the markets recovered. Insurance company AIG defaulted because they had written this insurance premium against the default. They never thought these bonds will default, so they had made no provision for the insurance premium which they had written. So finally, they had to be bailed out by the government of US. BKFI impact is still seen today. No, today, nowadays, we have a very strong domestic institution flow. So even if the FIs sell in a big way, it gets absorbed. It was not like that way back in 2008, where the FIs were much more powerful than the domestic institutions. Uh, Indian markets, it was more or less similar GH. Uh, so what happened was in January, February, March, the Indian markets corrected much sharply than the other markets. The reason here was it was doing a catching up because in October, November, December 2007, the world markets had started correcting, but India had not corrected. So when we started correcting in January, the fall was that much sharper. SS, yes, FDI will also get impacted if the economy goes into recession. Okay, so this was subprime for you. Uh, so what was happening at the macro level? The export slowdown, especially IT and textiles, where India is a very large exporter, because the demand from US and the Eurozone contracted. Your FDI and your external commercial borrowings also became costlier, right? The FDI inflows dipped because of global risk aversion. The only thing that was positive for India was the NRI remittances, mostly from the Middle East. So, some way this cushioned the external shock. Okay. What about the banking and credit dynamics? Uh, the best part was Indian banks hardly had any exposure to the subprime assets or a limited exposure. So, in that respect, we were not affected. Uh, NBFC liquidity crunch, uh, redemptions, because in a panic, people don't think rationally. There were huge redemptions, and your NBFCs and AMCs were badly hit. Domestic credit demand rose as external sources dried up. So this put pressure on the banks. Okay. Some statistics here, just have a look. The GDP growth, the export growth, and the fiscal deficit before the crisis, after the crisis. You have any questions, you can ask. Uh, Participants, I just hope that you are able to understand me clearly. Thank you, RK. Yes. So, how did RBI respond to all this? They would eventually cut the CRR. CRR is the cash reserve ratio. So, they would cut the CRR by 400 bips and the repo rate by 425 bips. Basically, RBI was now wanted to inject liquidity into the system. Liquidity was badly hit, and they supported NBFC and mutual funds via a refinance and liquidity windows. What did the government do? They boosted public expenditure and cut taxes to revive demand. So the Indian economy would slowly rebound after 2009, and in 2010 we had an exceptionally very high GDP growth of close to about 9 to 10%. So how why were we affected? Because we have to understand this that we are no longer a domestic economy. We are no longer an insulated economy. So global trends, global factors, global macros do affect us. Okay. Okay. Any questions? So one more thing, a lot of exotic derivative products were used in US and in the developed markets of Europe. In India, such products were not allowed. So because of that, they were not so much affected. Thanks to RBI. Right? Uh, my third case study example would be the uh, China Chinese yuan devaluation, which took the markets by surprise. Okay, this happened on August 2015. The People's Bank of China, they wanted yuan to be more linked to the market, so they devalued the currency. This sort of shook the market like a earthquake, and India was no exception. And I'll give you some statistics here. This is what happened on a single day in India on August 24th. The Sensex would correct by about 1600, 1625 points. The foreign investors sold 10,700 crores, the highest single day sell off since January 2008. And mostly some of the sectors which are dependent on China, like metals, etc., they were hit hardest because they feared that China could be dumping this all over the world and the demand will slow down. The INR depreciated, hitting about 66.49 because there was a outflow of USD. And the bond markets, again, the credit spread, which I mentioned earlier, it widened because of this event. So, at a broader, if you look at the macro level, a weaker Chinese currency will make Chinese goods cheaper. And this is not good news for other countries which are competing with China. So, it is going to hurt Indian exporter, particularly in textile, chemicals, and engineering goods, where we compete with them. So Indian manufacturer also fear that low-cost Chinese imports will be dumped in India, which will affect their margins. So what is the strategic insight here? That China's weight, obviously, it's a very large economy. You can't ignore them. So in this episode underscores how deeply we are tied up to the global capital flows and the trade dynamics. Uh, the RBI responded, they emphasized that India's macro uh, fundamentals are very good. The forex reserve were healthy, and all the fiscal metrics were stable, trying to pacify the market. The markets would then eventually recover, but the damage was done at least for the time being. So we'll try to now finish the session by looking at some major market influences. So first is the monetary and financial spillover. First is the US Fed policy. So rate hikes by the Fed Reserve will tighten global liquidity and it will attract capital flows back to US. So it is neither good for Indian equities nor good for the Indian rupee. Uh, Currency volatility, major currencies like the USD, the Euro, the Japanese yen, the British pound, Chinese yuan. Okay, this currency volatility is not good for imports and exports. People are not comfortable when the currencies are very, very volatile. And then, of course, the global risk sentiment because of banking crisis, war, pandemics. Whenever such events happen, we call it the money moves into safe haven or a flight to safety. So generally, what investors will do is they will sell equities and convert their money either into USD or gold. Similarly, the institutional and structural impacts, the regulatory benchmarking, technology and market integration, geopolitical realignment, all these impact the Indian markets. Shifts in supply chains and alliances, like what is currently happening. We are more focused towards BRICS, and we have ended up antagonizing the US, United States, who have now retaliated by imposing a 25% duties on Indian exports. So all these things keeps on happening. Uh, so if the developed world is doing well, then IT and pharma will do well, right? So the demand, because they are direct beneficiaries of the global demand cycles. Similarly, manufacturing and energy will be impacted by the global raw material pricing. And again, here China plays a very important role because, to give an example, he almost monopolizes the rare earth minerals. So the shortages that we are now seeing, especially in electric vehicles and the other semiconductors and other applications, is thanks to the some of the policies followed by the Chinese government, where they are controlling the supply of the rare earth metals. Banking and finance will be, we all know, they will be sensitive to the global interest cycles. Uh, so in direct economic channels, uh, the export demand sensitivity, your uh, I mentioned this earlier, IT services, pharma, your textiles, engineering goods. Okay, so they will do well when your major trading partners or the major economies, the Eurozone, the US, the UK, etc., they do well. Any slowdown happening in these economic zones will hurt these industries badly. Import cost dynamics, if there is a global supply chain disruption, it could be because of a geopolitical issue like the Russia-Ukraine war, for example, they can inflate the import prices. Balance of payment. India is a current account deficit country, and this is one of the reasons the rupee keeps on depreciating. So we need to take care of all this. The whole purpose is, if India becomes a great exporting country, uh, we definitely, the current account deficit that we perennially or we perpetually run, which puts a pressure on the rupee, I think at least that would be taken care of. Some sectoral transmission effects. Your auto electronics, they are reliant on the global value chains. In agriculture, we are very sensitive to what is happening in agriculture. So even with the UK FTA, which we finalized last week, we did not touch the agricultural part because it's a very politically sensitive issue. Textiles, we compete with not only with China, we also compete with Vietnam and Bangladesh. Okay, so the FTA with Britain is was done last week. Both the countries will benefit over a 10-year period. A lot of duties, 99% of Indian exports will attract 0% duty over the years. And some of the British exports to India, and that would include your some of their cars, their expensive scotch, etc. The duties will come down significantly. Okay, so the PLI scheme in India encourages everyone to set up a manufacturing unit in India and enjoy a cashback which is given by the government, provided the company meets certain targets. So a cashback would be given to that manufacturing unit or to that company for 5 years. Okay, so these are India's top trading partners. Just have a look. So no wonder the Trump administration is not happy with India because they are running a $36 billion deficit with India. So we run a surplus with them, but then with most other major countries we run a deficit. We run the largest deficit with China, which is currently about $85 billion. So this is just explaining the chart. Okay, fine. So we are at the end of the session. Thank you so much. If you have any questions, you can please ask. Uh, Carry trade is someone said carry trade is similar to with cryptocurrency trading. I think this was Sai Krishna. Sai no, they are completely different. They are completely different. Uh, Someone asked whether these type of transactions are prevalent now. Carry trade, definitely yes, because it's a financial market transaction. Uh, as a currency trader, if you see opportunity, Amitava, you will do it. We Indians do not do it because we have a capital account restriction, but most large institutions or players who come from country where there are no capital account restrictions will definitely do it. Whether raising loans against government, etc., to purchase more gold, no, this is not a carry trade. Currently, USD JPY is trading at 149 in the end of 56. What can we expect JPY will go? JPY USD has remained in a range. Pradeep Kumar Mathur, it has mostly remained in a range. And if the Bank of Japan starts increasing the interest rates, the JPY will appreciate. Why India cannot build independent economy? What are the limitations? Sunil, that is beyond the scope of these discussions because there are many factors here. How present US 25% tariff will impact India? It's not positive for India. Basavraj. From the past, can we say that in future related to cryptocurrency, there can be a global disturbances and thus impact on India? Right now, the quantum of cryptocurrency trading is not significant. Okay, so it's too premature to answer this today. But yes, PS, maybe 5 years, 10 years down the line, when it becomes a very prominent asset class, you it's possible that it can disrupt global economy. But right now, the impact will be minimal. GH, thank you so much. Any other questions? Please go ahead. We have some 2, 3 minutes more. SB, if such incidents happen in next coming days, SB idea is to look at quality stocks. Okay, because events will always happen as long as you're exposed to market. One time or the other, you'll have these events happen. But then what happens? Markets eventually recover. You focus on your stocks which are doing well, stocks which are profitable, stocks which are have very good operating margins. Uh, they're showing profitability growth. In the long run, you'll always make money. EK has asked, do you think as bond yield is rising and the 36 trillion US debt weakening of US currency and rising commodity prices will impact equity markets around the world or global crash in the coming years? Uh, if US starts deleveraging, it could be painful for equities, in which case the US markets will correct. But whether that will happen immediately in the near future, I have no answer. To your question, yes, $36 trillion of debt is very big. That is almost 9 times the size of India's GDP. So either US GDP growth should take care of this, or US will have to deleverage. Uh, Energy policies of global economies like Europe affect the Indian markets. It's more of an indirect way of answering this, PG, because see, we right now what we are doing is we are buying oil from Russia. It benefits both the countries because we get discounted oil. But now what has happened is uh, the US administration has said that if you continue to do this, we will penalize you. So we now don't know how the government is going to respond to this, whether we'll continue to buy from Russia or we'll start buying from the Middle East. We'll have to wait and watch for this. PG. For the sessions recording, you'll have to speak to the NISM. I'm not the right person. AC, that is your question. Anshul Verma, how confident Donald Trump is about the 25% tariff and extra penalty? Uh, Donald Trump के बारे में means what do I answer? What he is going to say tomorrow, no one knows. I तो definitely do not know, Anshul. The Indian economy is reasonably strong. So I think we should survive. Alternative energies will do well in the long term. Okay. Uh, Sahil, I think we are coming to the end of the session.
Okay, so some means we have to sufficient amount of questions, right? Or is it remaining to do?
Thank you all of you for being such a lovely audience. It was very interactive, and even I enjoyed the interaction with you. Thank you very
Thank,
much.
thank you so much, sir. I would like to extend our heartfelt thanks for taking the time to speak at the webinar. Your insights, expertise, and engaging presentation made a lasting impact on our audience. Thank you again, sir, for your time and knowledge.
Thank you.